Good morning, I'm Maiki Oreta and you're watching Business 360, where we break down the numbers, connect the dots, and give you the developments and the insights you need to navigate, adapt, and lead. Let's dive right in. Trump hits the brakes. A 90-day tariff pause offers relief to global markets, but China remains in the crosshairs. The Magnificent Seven add $1.5 trillion in value after Trump's surprise pause. Here at home, a ransom is paid, but lives are lost. A kidnapped businessman and his driver are found dead in Rizal, sparking outrage in the Filipino-Chinese business community. U.S. President Donald Trump temporarily pauses part of his tariff package, giving a 90-day window for negotiations with select global trading partners. The White House says the move follows a meeting with Commerce Secretary Howard Lutnick and Treasury Secretary Scott Bessent. The pause covers some U.S. allies but excludes China.
We don't want to hurt countries that don't need to be hurt, and they all want to negotiate. The only problem is, you can only do so many at one time. We want to do it right. We want to get it right. We want to take care of them, but we have to take care of our country. So, but this was something certainly we've been talking about for a period of time, and we decided to pull the trigger. And we did it today, and we're happy about it. I didn't know it would have that kind of an impact, but it's, I think they have the biggest increase in the history of the stock market. That's pretty good. You're almost, if you keep going, you're going to be back to where it was 4 weeks ago.
In China's case, tariffs have now been raised to 125% after Beijing announced a new round of retaliatory duties on American goods. Trump says he's open to meeting President Xi Jinping, but only if China shows good faith. This move underscores the volatility shaping global trade relations. While some countries get a temporary breather, others, like China, face escalating tariffs that threaten to further disrupt supply chains, slow demand, and redraw trade routes. As a trade-reliant economy, the Philippines must navigate this shifting landscape carefully, with exporters, investors, and policymakers closely watching for risks and opportunities across global markets. Let's take a look at how financial markets performed overnight as investors responded to a major development in the global trade front. U.S. stocks skyrocketed after President Donald Trump announced a 90-day pause on his reciprocal tariffs, with one exception: China. Wall Street, which had been on edge for days, took this as a sign that the White House could be flexible on trade policy. When Trump posted on social media that most of the tariffs would be temporarily halted, investors wasted no time buying back into the market.
The Trump administration is really doubling down on being tough on China. China is certainly not backing off. I think it will be interesting to see whether China reciprocates for a third time. I think that could be likely. But this is likely to reshape global trade if this persists. If nothing changes, 125% tariffs on Chinese exports to the U.S. is immense. We import a massive amount, hundreds of billions of dollars from China. That will have to go somewhere else. I think it's going to rapidly change supply chains for companies who now operate heavily in China.
The Dow Jones Industrial Average climbed 7.9%. The S&P 500 jumped 9.5%, marking its strongest rally since October 2008 during the global financial crisis. The Nasdaq Composite surged 12.2%, its biggest daily gain since the dot-com bubble in January of 2001. But over in Europe, stocks fell as investors there remain cautious. The UK's FTSE 100 lost 3%, Germany's DAX slipped 3%, and France's CAC 40 dropped 3.3%. The market swing shows just how sensitive global investors are to trade policy. Trump's partial pause offers temporary relief, but with China still being targeted, supply chains remain at risk. Philippine exporters and investors should stay alert, as the next moves could shift capital, costs, and competitiveness across Asia. While global markets breathed a sigh of relief after the 90-day tariff pause, tech stocks stole the spotlight, with Wall Street's most influential names staging a historic rebound. The Magnificent Seven, a group of tech titans including Apple, Nvidia, Microsoft, Amazon, Meta, Tesla, and Google parent Alphabet, saw gains of up to 23%, reclaiming over $1.5 trillion in market value in a single day. This comes after sharp losses earlier in the month and reflects how fast capital can rotate back into tech when policy uncertainty temporarily eases. But experts warn that this may be more of a snapback than a recovery. With China still hit by a 125% tariff, supply chains remain exposed. For the Philippines, a key player in semiconductors and electronics, the biggest risks and opportunities may yet be ahead. The trade war between the world's two largest economies just escalated further, with China imposing retaliatory tariffs of up to 84% on U.S. imports, responding to earlier tariff hikes by President Donald Trump. This move came before Trump unveiled his latest 125% tariff on Chinese goods, underscoring the breakneck speed at which this tit-for-tat escalation is unfolding. China's State Council Tariff Commission slammed the U.S. measures as a mistake upon mistake, accusing Washington of violating China's legitimate rights and damaging the global rules-based trade system. In a sign that tensions are spreading beyond trade, China's Commerce Ministry also blacklisted 6 U.S. companies, citing arms sales to Taiwan and their involvement in military technology projects as the reasons for that. China earlier warned that it would fight to the end if the U.S. proceeded with more tariffs. For the Philippine business community, this escalation may trigger new volatility in trade, capital markets, and supply chains. With U.S.-China relations at a boiling point, government and industry leaders here at home must stay nimble and strategic in managing exposure to global shocks. The Asian Development Bank warns that escalating trade tensions may weigh on Philippine growth, even as the country maintains strong macroeconomic fundamentals. In a new outlook, the ADB says heightened uncertainty from shifting trade flows, investment disruptions, and growing protectionism could weaken market sentiment and slow growth momentum. The lender also flagged geopolitical tensions, including the ongoing U.S.-China trade war, as a risk to commodity prices, which could further push inflation higher. Now, in response to these headwinds, the ADB trimmed its Philippine growth forecast to 6% this year, down from an earlier 6.2 projection, partly due to the lower than expected 5.7% growth recorded in Q4 of last year. This places the latest forecast at the lower end of the government's 6 to 8% target range. Still, the ADB says the Philippines is set to remain among Southeast Asia's fastest growing economies. But they do warn that major global shocks could erode that advantage if not carefully managed. Still on the ADB, the multilateral lender is now calling for deeper inter-regional integration as global trade tensions escalate and major economies turn inward. Our business correspondent Sujin Kim has the details.
Amid a deepening global trade war, the Philippines remains in a strong position, according to the Asian Development Bank. The country's electronics exports, particularly semiconductors, continue to rise, driven by the global AI boom. For now, these products are not covered by the new U.S. tariffs.
The services sector remains unaffected for the moment. The semiconductors for the moment also are exempted. We don't know what's going to happen, but for the moment, the Philippine economy is protected.
But the ADB warns that the escalating tariff war is already weighing on global and regional growth.
The tariffs will result in substantially lower growth for the global economy, for the U.S.
including the Philippines, to strengthen regional ties and trade linkages.
Economies may develop new trade linkages in response to shifting trade barriers.
This includes boosting free trade deals like our
export markets. It'll be strengthening and strengthening current free trade agreements and pursuing even more of those.
On the flip side, the ADB also sees potential gains for the Philippines.
There could be this trade redirection and potentially production relocation toward the Philippines, assuming that, again, there are many big questions on that. How persistent will these tariffs be? Right? So that's one factor that's working in the favor of the Philippines and might make the effect smaller.
Tariffs imposed on the Philippines remain significantly lower compared to other ASEAN countries.
Many developing Asian economies are among the hardest hit globally. The tariffs are particularly severe for some of the region's poorest economies.
In its latest Asian Development Outlook, the ADB downgraded the Philippines' growth forecast to 6.0%, slightly lower than the 6.2% projected last December.
From 6.2% in December actually considered the lower than expected turnout in Q4 of 2024 because we have seen household spending growth moderated more than we expected. This was also actually as effect of the lingering impacts of high inflation.
The ADB emphasized that only 3% of the Philippine GDP is tied to U.S. demand, meaning 97% of the economy will likely stay shielded from the new tariffs. Sujin Kim, Bilyonaryo News Channel.
The Marcos administration says it will not retaliate against the United States after President Donald Trump slapped a 17% tariff on Philippine exports. Trade Secretary Cristina Roque says that the country will focus on expanding trade with other partners instead. She argues that the U.S. policy could actually work to the Philippines' advantage, as select local products like coconut-based goods and dried mangoes remain competitively priced compared to neighbors hit with higher tariffs. For instance, dried mangoes from the Philippines will face lower duties than similar products from Cambodia, which was slapped with a 49% tariff, or Thailand, which faces a 36% rate. On another front, the government plans to raise at least 30 billion pesos next week through a fresh offering of 70-year fixed-rate treasury notes as it looks to shore up funding amid rising global uncertainty. National Treasurer Sharon Almanza says the move will establish a new 10-year benchmark bond, providing a reference rate for long-term funding and helping guide investor decisions across debt markets. The Bureau of Treasury will hold its price-setting auction on April 15th, with the public offer period running through April 25th. The issue date is set for April 28th. For investors and the business community, this comes at a crucial time as volatile markets and trade tensions continue to rattle global capital flows. How the auction performs could signal confidence in the country's macro fundamentals and influence borrowing costs in the months ahead. A businessman and his driver, kidnapped nearly 2 weeks ago, have been found dead in Rodriguez, Rizal, despite the payment of ransom. The victim has been identified as Anson Ke, the owner of Ellison Steel. His driver, who has not yet been named, was found alongside him. Reports indicate that the family paid over 100 million pesos in ransom, raising alarm over the brutality of the crime despite cooperation. The Filipino-Chinese Chamber of Commerce and Industry has expressed deep concern, calling for stronger protection for the business community. This tragic case highlights the growing security risks faced by entrepreneurs and investors in the country. For the business sector, it's a stark reminder that economic growth must go hand in hand with safety and the rule of law. We're taking a quick break. Please stay with us as we dive deep into the numbers and the narratives that matter most to your bottom line. Let's take a look at how Asian bourses are moving this morning. Right now, the Nikkei 225 is higher by 8.4%. Hong Kong's Hang Seng Index higher by 4.6%. Shanghai's composite higher by 1.5%, and Singapore's Straits Times Index higher by 5.7%. So big gains here in the Asian region so far. Let's take a look at how our market is doing. Here at home, Philippine markets are resuming trade after being closed yesterday for the Day of Valor holiday. On Tuesday, the PSE index finished at 60.06, up 3.2% as investors went bargain hunting following Monday's rout. Analysts say that gains may continue today, driven by the anticipation of a rate cut by the Bangko Sentral ng Pilipinas and from hopes of a de-escalation in the global trade war. The central bank is widely expected to cut rates by at least 25 basis points this afternoon in a move that could boost market liquidity and support investment sentiment amid global uncertainty. Taking a look at the PSE index as of 10:19 this morning, the main gauge is sharply in the red, higher by 1.84% to 61.16. The broader all shares index in the green as well, starkly up by 1.4% in early trade to 36.32. Taking a look at the sub-indices, it's a sea of green. The financials, industrial, holding firms, property, services, and mining and oil counters are in the green, with the mining and oil counter and the holding firms counter up the most, up by 3.8% and up by 2.8% respectively. Meanwhile, in the currency markets, the peso opened stronger at 57.18 to the dollar, appreciating from its previous close of 57.31. This as traders position ahead of the BSP's policy decision later this afternoon. For Philippine investors, this week is a test of confidence, with rate cut hopes and trade developments driving short-term momentum, while volatility in the global markets keeps the risk sentiment in check. On the corporate front, Bilyonaryo Ricky Razon's International Container Terminal Services Incorporated buys back 2 billion pesos worth of shares in a strategic move amid intensifying global trade tensions. ICTSI repurchased 6.5 million shares on Monday at prices between 313 to 320 pesos, accounting for half of the day's total trades. The buyback came as markets plunged following U.S. President Donald Trump's latest tariff escalation. ICTSI shares fell 5%, hitting a 10-month low of 320 pesos as investors reacted to heightened risk of supply chain disruptions from the U.S.-China trade war. For the Philippine business community, ICTSI's buyback signals strong internal confidence despite external shocks. But as a gateway to global trade, ICTSI and other export-exposed firms will remain in focus, with tariffs, shipping rates, and trade flows now driving investor sentiment. Now, the Land Transportation, Franchising and Regulatory Board, or the LTFRB, issues special permits to over 1,000 provincial buses to help ease the expected surge in Holy Week passengers. LTFRB Chair Teofilo Guadiz III says that these special permits will be valid from April 11th to the 27th, covering both the Holy Week exodus and the return travel days. The agency has also deployed teams to conduct random inspections of public utility vehicles, terminals, and operators' documents to ensure safety and compliance throughout the rush period. For the business community, mobility is more than just a movement. It's a driver of spending, ensuring smooth, safe travel over the holiday week, supports domestic consumption, boosts regional tourism, and keeps the economy moving, even during peak breaks. Elsewhere, Israeli Prime Minister Benjamin Netanyahu takes the stand in his long-running corruption trial at a time when global markets are closely watching Israel's political stability amid tensions, escalating trade tensions worldwide. Netanyahu's appearance comes just days after his meeting with U.S. President Donald Trump, where trade and security cooperation were front and center, particularly as the Middle East seeks to stay resilient amid tariff shocks and geopolitical risks. The case, involving allegations of graft, bribery, and regulatory favors to media firms, could influence investor confidence in Israel, a key player in global tech, defense, and energy markets. As the world navigates a fragmenting trading system, political uncertainty in influential economies like Israel may add further volatility for global businesses and capital flows. Now, here at home, a new warship arrives in the Philippines, boosting the country's naval firepower amid growing tensions in the West Philippine Sea. The BRP Miguel Malvar, a brand new guided missile corvette from South Korea, docked in Subic this morning. It's the first of two advanced warships acquired from Hyundai Heavy Industries under a 70 billion peso modernization deal. Defense Secretary Gibo Teodoro says that the vessel's arrival marks a significant leap in the country's ability to protect its waters and trade routes amid persistent maritime threats from China. For the Philippine business sector, this signals stronger security around critical infrastructure, including sea lanes used for energy, trade, and logistics. And that's it for Business 360. I'm Maiki Oreta. Keep it here on BNC, the Bilyonaryo News Channel.